Final example, let's assume this reserve ratio of 10%. So if a bank has deposits of $100,000, so that means it's a liability of $100,000, and holds $10,000 as reserve, so that's the required reserve ratio. How much are its excess reserves? Okay, so meaning that, let's say $90,000 was lent out. It lent out $90,000. Then how much of that $10,000, assuming an RR of 10%? Well, if the RR is 100,000, okay, again, times the multiplier, which would be, actually there's no multiplying right here. So if it's $100,000, 10% of that is going to be 10,000. That's the required reserve. So if the ratio is 10%, so the RR equals 10%, the required reserve is going to be $10,000. Well, if the total is 10,000, the excess reserve, zero excess reserve. So there's no excess reserves. So if a bank puts himself practically in this position, it's kind of a precarious situation, because chances are if someone takes out a deposit, then they're going to have to borrow money either directly through the Fed or through the Fed funds process, because they don't have the money. So they're going to have to meet the requirements set by the Federal Reserve. And so they're going to loan money either through the federal funds rate or through the discount rate somehow. Okay. Now, by how much will an increase in excess reserves of 20,000 generate in the money supply using the money multiplier formula? Again, very simple equation. You have $20,000 in excess reserves. Multiply 1 over RRR, which is 0.1. And again, the multiplier is going to be 10 in this case. So you have 20,000 times 10. So the increase in money supply, according to the money multiplier formula, is going to be $200,000. So again, this is assuming that there's no leaks and the money is multiplied fairly rapidly. But in the real world, you have money multiplier formula of 1.9. In times where people aren't spending a lot of money, then it might be closer to 0.8. What a disaster it would be in our economy if our money multiplier formula was 0.1 or 0. If people weren't borrowing money, the way we have our economy set up through banks, it'd be a severe shock to the system if people just stopped lending. If banks for some reason stopped lending out, it shows you how reliant our economic system is on understanding this banking process and kind of navigating through the system. Thank you for watching Educator.com.